So, welcome back. Thanks very much for taking a bit of time to watch this. It has been a very volatile time in investment markets. So we wanted to take a little bit of time to look at what has been the main reason for that, and does it give us some kind of indication as to what we can expect going forward. So just to share my screen here, it's been a very bumpy ride over the last 12 months. You can see the world index down almost 4%, South African index up about 3%, but the rand has been completely hammered, as you can see there, the exchange rate. So it's been a very difficult time, to say the least. What has been the reason for all of this? So there's a lot in the news about the war and politics and things like that, but by far the biggest reason has been interest rates, the expectations and the rapid rise in interest rates. Now, the reason interest rates are such a big determining factor to what we see on our investment statement is a few things. It's not limited to this, but there's a few main things. Firstly, obviously, companies that are listed on the stock exchange, which make up our portfolios, have varying degrees of debt. Those with large amounts of debts obviously have higher repayments when interest rates go up, and that reduces their profits, so that reduces their share price. Also, there's varying expectations of future growth at different companies. So a company like Tesla, with huge expectations for future growth, is going to be affected by these raised interest rates a lot more than a company like a food producer. And that's because those expected future earnings also have to be discounted at a rate to get a value for that company today. And when the interest rate goes up, it's now discounted more than it was before, and that value immediately drops. Similar theory, but obviously quite different with government bonds. When you're buying a bond, you're effectively buying a stream of future income. Again, if those future incomes are suddenly discounted at a higher rate, it means the value of those future incomes, the value of that bond suddenly drops. High interest rates are also just sort of generally negative. Companies, regardless of what industry, what kind of company, generally need funding to be able to grow, to be able to buy more machinery or more properties for growth. And when interest rates are higher, that desire to lend or to borrow is far less. And so there's sort of negative general sentiment across the general stock exchange is felt. So the question is, why are interest rates being increased? And the primary reason is because of inflation going up. So central banks have two major roles. The first one is to keep inflation in check. If inflation gets out of control, then obviously standard of living for everybody is severely affected. So in the developed world, and particularly the US, inflation actually has now got out of control, you could say. And the reason we say that is, in theory, as inflation starts picking up, the central bank will raise interest rates, and that will slowly bring it back down again, and then they can reduce those interest rates again. But during the pandemic, interest rates inflation sort of started shooting up. The main reason initially was supply chains were disrupted, so you couldn't get stuff, so stuff became more expensive. But also now there was a lot of money being pushed into the system to support the economies. That came to people who wanted to spend it. Other people who already had lots of money hadn't been able to spend what they wanted to for like 2 years. They wanted to blow their cash. So there was this huge demand, not enough supply, and inflation started going through the roof. Now, the central bank didn't raise interest rates because they were under the impression that it would be sort of transitory, they used the word. And after the pandemic, things would just go back to normal. So, inflation would naturally just drop down. But that obviously has not at all been the case. So now they're trying to catch up. But the only way to do that is to aggressively raise interest rates, which is sort of the recipe for disaster when it comes to investment markets. You may be asking, though, we are not living in a developed world. So yes, our supply chains have been affected, even worse now recently by strikes in Transnet, but we don't have that same kind of demand push where people have all this extra money that they want to spend. And that takes us to the second role of a central bank in this case now the South African Reserve Bank. One is to control inflation, but also they have to retain the value of our currency, because if that gets out of control already, I mean, it's already bad. We're down to 18.31 to the dollar today. But if that got completely out of control, obviously we import goods for most of our goods. So our cost of living inflation would get ridiculous anyway if our rand wasn't in some way protected. So what determines the value of the rand? And that is mainly determined by how much foreigners want to invest in South Africa. Obviously, our local politics does play a role there, but an even bigger role in the value of the rand is when they're looking at the whole world, international investors, and they look at, okay, well, I can get this much return from a very stable government bond like a US bond. I can get a greater return from more riskier bond like a South African bond. If that difference is big enough, then I'll invest there. But now, as interest rates are raised in the US, that difference is reduced. And so the incentive to invest in a more riskier country like South Africa drops. And the only way to retain that incentiveness or that value is to raise our interest rates as US interest rates are raised. So that kind of explains what's been happening, why interest rates across the board have to be raised. So not a pretty picture. And we know that interest rates have to keep going up for a bit. So amid all this, is there any kind of sort of silver lining that we can look forward to? Well, there is some key things that we should bear in mind, which does definitely help. I'm just going to share my screen again now. This is, if you have a look here, sorry, this is the bull and bear markets in the US since 1926. So why are we looking at the US? Well, they are the driving machine of the world economy still. So whether you're on the 5th carriage or the 15th carriage, it's the steam engine in front that determines what happens, and that is still the US economy. So we can still look at this as a good gauge. As you can see, over the last, since 1926, bull markets far outweigh in duration and in size bear markets. So that's just good to bear in mind. We are in a bear market at the moment, but it's definitely not going to last as long as the bull market that has been happening for a long period of time. So our natural thinking is, well, okay, well, if we know we're in a bear market, why don't we just get out the market, and as things start picking up, get back in? But that would obviously be a massive problem, because this is now the South African Stock Exchange, if you have a look at that. And you'll see the top 3 lines here, the gold one and the red one and the blue one. This is what the South African Stock Exchange has done over the last 20 years. The red line is if you had just missed the 5 best days in the market. So when things suddenly corrected positively, if you just missed 5 of the best, there's about a 20% difference there. And if you missed 10 of the best, that's almost another 20% drop. So it's just too risky to sort of disinvest completely and then say we'll get back in when things pick up. We just need to miss 1 day, and there's just this loss that you can't recover from. And this next slide, again, this is now looking at the US over the last 20 years. The actual stock exchange, the S&P 500, has done 8%, but the average investor has only had about 4.5%. And the biggest reason for that difference, obviously there's some things like they didn't have money at the time, or they had to take money out for an emergency. There's also a little bit of expenses, but the biggest reason is this behavior. When things drop, panicking effectively and taking money out, thinking, well, we'll get back in later, but that loss is now locked in and you can't make it back. So it's very clear from that sort of over time, things will recover, and it doesn't make sense to try and time the market. It's just not going to happen. So another thing, we can see that inflation has already started to drop in the US. That's been shown, but obviously not enough. So interest rates will still continue to go up for a while. The big question obviously is, when is the bottom going to be? As we've just mentioned, we're never going to time it, but it'd be nice to have some kind of indication. So there's two leading indicators with a very good track record of calling the bottom of the bear market in the S&P 500. And they, at the moment, put the value of the S&P 500 at the bottom of between 2,900 and 3,300, sort of somewhere there as the S&P 500 value. Today, it's sitting at 3,500. So it's not quite there, but it's a lot closer than it was a year ago, which was 4,443. So we can say that, yes, over the long term, those periods of positive are going to far outweigh the negative periods. But for someone like a retiree, and obviously we're talking to those clients, they are having to draw money out. So that is where our focus is at the moment. There are certain things that we can do. So you'll be getting communication quite soon about some changes that we want to make in that portfolio for retirees. One of the things is to bring some money back from overseas. With the exchange rate where it is now, it's so far away from fair value that's almost like an easy win. Also, just maybe using government bonds a bit cleverer now that these interest rates have come up so far. But the big focus is to sort of protect that loss as much as possible and be ready for when things do pick up. It's been quite a bit. Thank you very much for watching. If you have any questions, please let us know. But we really appreciate you being able to have a look at this, and hopefully can hear from you soon. Thanks very much.